Hello and welcome back. In this video, we're going to conduct some analysis, some ratio analysis. So this is probably, well, it is some of the funner stuff that we get to do with accounting information. Up to this point, it's been a lot of bean counter information, right? We got to keep track of this, keep track of that, prepare the reports, do the journal entries, prepare the reports. Now, once the reports are prepared and we understand what we're doing as far as why we're putting things or putting accounts on specific financial statements, now we can do some analysis, right? Now we can play with the numbers, so to speak, calculate the numbers, see how they interact with each other, and we can make determinations on how good the company's doing, right? How profitable it is, how liquid the company is, what's the company's solvency. So in this video, we're going to look at liquidity or assessing liquidity and assessing solvency. So in order to do those two ratios, guess what? We got to look at the balance sheet, right? Remember what the balance sheet is. Assets equal liabilities plus owner's equity. So when we're looking at liquidity and solvency, we want to see how liquid is the company, right? How quickly can they turn their assets into cash, right? We want to look at things like solvency. How solvent is the company? How much debt do they have? How much equity do they have? So we're just going to touch the tip of the iceberg in this video. There's a lot more liquidity and solvency ratios that are out there. You'll probably cover that when you get to Corp Fin or corporate finance. So right now we're just kind of gonna wet your whistle a little bit, so to speak, looking at some of the ratio analysis. Okay, so what exactly is ratio analysis? Well, if you've had any math course, really, you get into division, right? And basically what we're looking here is we're looking to compare two numbers, right? So we want to express one relevant number to another relevant number is really all we're doing. And we're doing that through division. And it's funny, a lot of people think like, oh, you must be good at math if you're an accountant. Yep, nope, not really. Because as you've seen up to this point, we don't do much math other than addition, subtraction, multiplication, division, right? That's all we do. It's funny, back in the day, I used to be really good at mental math, but now, working as an accountant for so long, I use an adding machine for everything, right? And you'll see, especially if you get into accounting, you're using an adding machine to adding up all the numbers and whatnot. So anyways, let's get back to ratio analysis. So all we're doing is trying to determine or trying to express one important number to another important number. We're going to do that using division. Super simple, right? What ratio analysis does is it allows us to provide a basis for further analyzing a number, right? So we're going to get a number, and then from that point, we can go ahead and analyze it, right? Now, we're going to see as we go through some of these ratios that by themselves, they mean nothing, right? Current ratio is 1. Is that good or bad? I don't know. The point is we need something to compare it to, okay? You always need something to compare it to. Well, there's two things we can do. We can do trend analysis, which means we compare a number over time. So we have a company and we see that their current ratio, we'll talk about what that is in a second here, but we'll say, this year it's 1. Well, last year it was 0.9. The year before that it was 0.8. Year before that maybe it was 0.5. So based on trend analysis, yeah, our current ratio is improving. That's a good thing, right? Our numbers are getting better. Another thing, or another comparison that we can make is we can use benchmarking. I mean, we're going to compare our number or our current ratio to our closest competitor. Or maybe we can compare that number to the industry standard. The point is, ratio analysis by itself, it's really not that helpful. We need something to compare it to. We can either do trend analysis or we can do benchmarking. So we're going to, again, work with the balance sheet. And remember, the balance sheet is assets equal liabilities plus owner's equity. How much, well, for lack of a better term, how much skin in the game do the shareholders have compared to creditors, right? So the balance sheet really allows us to examine the health or the financial health of a firm, okay? So when we're looking at assets, right, or when we're looking at the balance sheet, we want to know, how are those assets funded? Meaning, are they funded through debt? Do we have a lot of creditors or loans out there? Is it funded by equity, meaning stock, right? Did we get more investors? Or we can look at retained earnings, right? Is the business financing itself through retained earnings? Okay, and think about this in your personal lives. This definitely can work. Okay, think about when, maybe when you were a little younger, right? I know my parents, when I was younger and junior high, and kind of stopped in high school because I got a job, but like junior high, I got an allowance, right? Okay, so what did I get an allowance for? Well, I got an allowance for, doing chores around the house. Well, I earned that money, and instead of spending it, I saved it, right? Actually, I spent it, but let's say I saved it, right? And I could take that cash that I've earned and I can reinvest it in myself, right? That's what retained earnings is. The company's earning income, instead of distributing it to, shareholders or paying off debt, they're holding on to it and they're going to reinvest in themselves, right? Case in point, you want to buy a car, right? There's two things you can do, right? You can either borrow the money from, maybe you and your if you have a sibling or a parent or whatever, maybe you can go in halves and buy the car, or you can buy it yourself and go to a bank, get a loan, or you earn the money, you just save it, right? So that's how assets are funded, either debt, equity, or the business themselves. Okay, so when we're looking at a firm's liquidity and solvency, that's pretty much what we're determining. We're trying to figure out, okay, how are these assets funded? Okay, so let's look at liquidity first. Liquidity is the ability of an organization to pay short-term financial obligations. Okay, so we already learned that the balance sheet is broken down into subcategories: current assets, current liabilities, long-term assets, long-term liabilities. So what we want to know is, when we're looking at liquidity, hey, what's the amount of cash that we have and how quickly can that cash be generated, right? How can we take those assets, convert them to cash? So one of the most common ratios we'll see is the current ratio, right? And the current ratio is the amount of current assets relative to the amount of current liabilities, right? Because we said that's what ratio analysis is. We're comparing one number to another number, right? So we're going to compare current assets to current liabilities. Mathematically, to do that, all we're going to do is just divide. Take our current assets, divided by our current liabilities, we get a number. That's it. Pretty simple, right? So when we're looking at solvency, right? Solvency says, what is the company's ability to pay their long-term financial obligations? Okay, so when we're looking at solvency, we want to measure the company's ability to survive over the long haul, right? In accounting, we say indefinitely, right? So some of the common ratios the one common ratio that we're going to look at in this video is the debt to total asset ratio. Okay, what does the debt to total asset ratio tell us? Well, first of all, it measures the riskiness of a company, or the riskiness of their solvency, so to speak. Okay, what do we mean? Well, remember, let's think back. There's three ways that a company can finance their assets: debt, equity, or through retained earnings. Okay, so the debt to total assets ratio says, how much debt does a company use compared to their total assets. So the more debt that a company has relative to an assets, we say the riskier it is. Now let's think about this. Why? If our if our assets are financed through debt, through bonds, whatever, guess what we have to do as a corporation? We need to pay interest expense. And eventually we're going to have to pay back that money that we borrowed, okay? So that's why we're saying that the more debt we have relative to the assets, the more risk we have with the company. How do we compare debt to total asset ratio? Well, we take our total liabilities. Notice here we're using total liabilities. That means the current liabilities and the long-term liabilities. And we're dividing it by our total assets. Again, we're taking our current assets plus our long-term assets. Okay? Now, let's go ahead and look at some of the income ratios or the income statement ratios. So we're going to look at profitability. How profitable is a company? So when we're working with the income statement, remember that sales, from a high level view, it's sales minus expenses, right? But we introduced that multi-step income statement. So we have a number of different stop-off points, so to speak. We have things like gross profit, income from operations, things like that, okay? So what these profitability ratios do, they allow us to analyze profit or net income, right? So the common ratio, there are a number of common ratios. We're going to look at specifically one. But what these common ratios do is, or what the common ratio does, it looks at return on sales ratio. What's the return on our sales? Okay, this is very nice and very useful when we look at companies that are different sizes, right? Can we compare a mom and pop grocery store to one of the major chain grocery stores? We'll just say Giant Eagle, right? Well, it's going to be kind of difficult because I'm going to assume Giant Eagle from a corporate standpoint has a lot more sales than our little mom and pop shop does, right? So we can use sales ratio or return on sales ratios to determine, hey, how profitable are each of these companies, even though they're different sizes? So how do we calculate the return on sales? Well, we take our net income divided by our net sales. That's it. Pretty easy, right? So let's kind of continue on here a little bit, and let's look at the components of stockholders' equity. I think this is going to kind of be a review because I think in the past videos, especially Chapter 3, we kind of looked at stockholders' equity pretty good, right? So we already know that the statement of stockholders' equity has two parts, right? How much did owners contribute to the company, right, by buying stock? And then we have that earned capital, so to speak, right? That earned capital is what the company earned by, reinvesting in their business, making net income, not distributing that to their shareholders. That earned capital, that's our retained earnings, okay? And we said in the past video, we already demonstrated how do we calculate retained earnings, right? Well, we say we start off with our beginning retained earnings. We add net income. We subtract out our dividends. And that equals our retained earnings at the end of the period. Okay, so I'm hoping some lights are going off and you're like, oh yeah, we talked about that in one of the previous videos. Yep, makes sense to me. If not, let me know. We can discuss it. Okay. When we come back in the next video, we're going to look at cash flow statements and how we can use the cash flow statement to hopefully assess a company's solvency. But let's not forget what our important takeaways are, right? We looked at ratio analysis. We know what ratio analysis is, right? We're just expressing one relevant number to another relevant number by dividing them, right? We know that ratio analysis by itself isn't very helpful, right? We need something to compare it to, right? What are we comparing it to? Well, we're either going to compare it to trend analysis, meaning over time, right? Or we're going to use a benchmark, maybe our closest competitor or an industry standard, okay? So we're going to look at our ratios, and we're going to say, okay, is this a good number? Oh, by itself, no. However, to improve ratio analysis, we need something to compare it to. We looked at the balance sheet, right? Should be a common knowledge, or should be known that, okay, assets, we got to fund them. There's 3 ways we can fund them: loan, stock, or through retained earnings, right? We looked at liquidity. Liquidity said we're going to go to the balance sheet. We're going to look at the company's ability to pay short-term financial obligations by using the by using the current ratio. That's current assets divided by current liabilities. We're going to look at solvency, right? Solvency is another ratio we can use. We're going to, sorry about that, solvency, we're going to use the balance sheet. We're going to in solvency measures what's the ability of the company over the long run, right? We're going to look at the debt to total asset ratio. Then we examined some of our profitability, or one of our profitability ratios. We said that in order to get the profitability, we got to look at the income statement. We're going to analyze profit or net income. One of the common ratios is net income divided by net sales. And then we jumped into stockholders' equity. Again, kind of a quick review here. You should already know what the 2 parts of stockholders' equity are, and you should know how to calculate ending retained earnings. So again, when we come back, we're going to look at the cash flow statement and how does this help us assess solvency. So tune back in for that video.